Dear friends, hello everyone. Today you and I are going to talk about a very interesting topic called market structure. Of course, all beginners who come to trading mostly use various indicators for trading, study some patterns. But friends, I'll teach you how to feel the market and without any additional tools. The most important indicator is the price itself. Okay, so what is market structure? I'm going to explain in my own words. None of this learns scientific language. Market structure is, so to speak, the skeleton of the market. How do you figure that out? Well look, here we go with the schedule. Simple, huh? We see a downtrend with you, a correction. Correction, that is, when we have a pullback on a downtrend, or we have a pullback on an uptrend. It's called a correction. We went down, bounced up a little bit, went down, bounced up, went down again. Fell down a lot here, went sideways, went up, went down, and this is all, it is formed. This is the skeleton, some certain structure is formed. Accordingly, market structure is the direction of price. That is, either we go down, we go up, or we go sideways. Accordingly, a trader must be able to trade in both trend and sideways. But I would like to say at once that it is always a little bit more difficult to trade in a sideways situation than when the instrument is in motion. Note, this coin we have is a mask. Here in this case we have a tool. How much time is there in the accumulation? Well, somewhere around 80 to 85% we stand in accumulation. I mean, look closely. Yes, here we go sideways. And then again, some sideways movement. Here, look, a little one, already a little one. We've got a really big sideways move right here. It's sideways here, sideways here, sideways here, globally sideways here. Accordingly, the most time the price is saved up. And if the energy doesn't build up, the market can't go anywhere. Accordingly, of course, if you know how to trade well in the sideways, you will trade 80 to 85% of the time. Next. Now you need to understand what a bullish trend even is. I'll draw it now. Let's get a tool. I'm gonna find him now. Okay, we need a trajectory. Went up, went down, then went up again, went down again. I have a little bit here. Well, and off we went again upstairs. Well, let's say. This is how our bullish trend is shaping up. When each extremum is higher than the previous extremum, that is high, then we have a high forming even higher, then we have a high forming even higher. Low, then forms low even higher, and forms low even higher. So we're in an upward movement. It's a bullish structure. Next. What is a bear structure? When we're going down and we're trending like this. It's working. We're low, next low is even lower, next low is even lower. High, the next high is even lower, the next high is even lower, the next high is even lower and even lower. Now, this is going bearish, which is a downward trend. Next. When we have a bullish and bearish trend, we have various corrections along this trend, yes, that is, along the direction of this trend. Any local pullback, that is, globally, yes, we go up or globally we go down, and any local pullback is called a correction. I mean, we've gone up a notch here. Here, let's say we went up, adjusted, rolled back. Went up, corrected, pulled back. Went up, corrected, pulled back. Same here. Corrected down, went up, went down again. So we didn't renew the previous high, we went back down again. We didn't update the previous low here either, we went back up again. This is how small global trend corrections happen. Why do I always tell my students, friends? It is best to trade on the trend, there is a lot more money to be made on the trend. You don't have to catch these little pullbacks. If you see that the instrument is globally in a bullish trend, then wait for an upward signal. For example, corrective bounces on a bullish trend work very cool. On the bearish side, of course, corrective bounces. It's very difficult to trade, but on the bull it's working very well. So the spot is making a pretty good profit right now. Next, of course, is this structure, and you should never look at some. If there is such a structure, then you should look for it on the chart like this. No, it's actually going to look all different. It's not going to be all that perfect. I mean, for example, a bullish structure would look like this. Some kind of, like this, yeah, with different kind of pro trades, and the bearish structure will look like this, for example, and then we can reverse again, go to the upside, that is like this here, that is. It's not going to be perfect all the time, and that's basically what it's going to look like. Of course, bullish and bearish structure, it can break down. How does it break down? First, we have a trend break level. You need to understand, yes, how it is formed, and therefore the structure itself. It can break when you update low or high. Once again, we are now with you. Let's draw. Okay, let's get a trajectory. How does the bullish structure break down? That is, we go to the upside, higher highs than the previous ones and higher lows than the previous ones are formed. Then at some point the tool drops and makes, let's say, a movement like this. We had a pullback level here, a lower pullback level. And, accordingly, we stab this level either by a false breakdown, or consolidation may occur, in principle, here, and we can bounce down from it here. Either we can make a false breakdown, go slightly to the upside, and then update the previous low. So here we had a low, here we updated it, and then we go down from here. That is, the bullish trend breaks in this way, the bullish structure breaks, respectively, the bearish one can also break in the same way. That is, we were calmly going down, adjusting, then at some point we break here, we do so, yes, and go up. I mean, we're breaking down. This place made a false break, pulled back, went up. That's what the word market structure looks like. You don't have to think head and shoulders formed here. Now some will say, yes, it's head and shoulders here. Are you head and shoulders a reversal pattern? No, head and shoulders may not work out. Don't think that all patterns they always work out 100%. Head and shoulders may not work out. See in which case. Let's say it's a reversal formation, kind of like the market structure is breaking down. If we went to the upside, we formed the first shoulder, formed a head and formed another shoulder. If the breakdown and fixation below this neck, it is called the neck, this horizontal level, will not happen. So we're right here, if we don't close in the charted area, and the tool will come here. We can bounce back, go up. I mean, you know, the structure might not break. It's important for us to update this one, so that we go down to the chart zone here, to consolidate here and go down. Only then will our head and shoulders work. Again, you need to realize that any pattern, any figure of technical analysis, also consists of levels and trends that break or do not break. Just like that. Next. That's the thing about trends. We also have sideboards available as well. So, let's you and I draw a sidewall. Every sidewall has an upper boundary and there is a lower boundary. What are the mechanics of lateral movement in general? For what purpose is it being instigated by a major player? To gather a position for yourself or to unload there and shop lower, for example. So we go sideways, for example, we encounter some point from where we have an upward movement. That is, the bears begin, accordingly, to close their trades, and the bulls begin to open their trades on. Not in the direction of the trend, but against the trend. And the instrument comes to the next level, which is also a limit player. A big limit player has set a level, and will not let it go higher, in order not to break the market structure, because if you let a lot of bulls above this level, they can simply break the structure, and the trend can turn, which the big player does not need at all. So we're not going to break the structure. A big player will never break a picture against himself. Consequently, he will save up here. He will even make some false breakdowns. Yeah, we're going up and down from here. Up and down, we may not get it. We may start to consolidate like this, and at some point a major player starts to come out of the sideways. Well, let's say we go down, we break the lower boundary. The big player, of course, will certainly show which boundary he will break, the upper boundary. Or the bottom one. Yes, you should definitely look at how the price behaves, what it shows, near what level it, so to speak, rubs. And, accordingly, if, of course, we are close to the lower level here, walking, we do not roll back from it. Yes, at some point there is a squeezing to this level. For example, we had a false breakout, but there was no reaction after the false breakout, and we go back to that level again, then we will break out and go lower. Same with the top one. With an upper level, an upper boundary. If we were to walk here, we would consequently go up here at this point. But again, there are certain prerequisites. You have to know them, understand them, yes, and see it all on the chart. So here it is. Basically, it is very good to take breakdowns when we come out of the sideways. Therefore, the level breakout strategy implies that there must be accumulation, good accumulation, on the chart. And we highlight the upper and lower boundary of this sidewall, and accordingly we will analyze whether we will go up or down from it. So, you need to understand when a tool has gone sideways. Let's have a look. First, no, not on a graph, first we'll draw. So, we have a movement, yes, some instrument falls sharply downwards. Let's say we have some point and we do a roll back from it. And then from that point on, we do some backtracking again. And we're already getting the idea that some sideways movement may be forming. So by the lower point we drew the lower boundary, and by this upper point, we drew the upper boundary. You and I understand that if the instrument comes up here again, perhaps you and I will take a buy and trade up to the upper boundary of this channel. If the instrument, let's say, fits here, we'll take the short and trade here. So you and I understand that the instrument will probably go sideways. Again, we will understand this by mechanics. If from the middle, let's say, of the channel, we fly sharply down here, quite distributively, then, of course, there can be a false breakdown, a stab, and we will roll back to the upside. That is, we need to understand when the sidewall starts to form. Let's look at the graph now. See, we had a promotion going on. So we're trending up. Yeah, here we went up, here we went back down a little bit. I'm gonna do a little market simulation here. Here you go. You and I take and set the upper pullback level here. Just like that. Next, we have the next green bar forming. We're updating the highs here. Are we going to move this level over this bar? No. Why? Because the level is not adjusted. It would have corrected if this bar had closed above the $6.5 level. If the closing occurred below the level, then the level is not corrected. Keep scrolling. We get to some level, some point, and we have a bounce to the upside. You and I are setting another boundary here. Here we have two boundaries formed, an upper and a lower boundary, and perhaps here the instrument will become an accumulation. There you go, yes, it's gone downhill from here, let's say it's gone downhill from there. Here we have a false breakdown with 3+ bars, yes, we are going down further. That is, the instrument stands in accumulation. At some particular point, we may break these levels, we may pierce these levels, we may make false breakdowns. Here, for example, the formation is more likely to be a good short right now. That is, it is possible that the instrument will not come back again in accumulation because we are consolidating here under this level. And the instrument goes down quite calmly, quietly and accumulatively. That is, we realize that at some point the instrument has come out of the sidewall and went into a trend. So that's what I tried to explain to you today, the market structure. I hope you enjoyed the video. I'll try to record more of some instructional videos. I wish you good luck, good mood. Ask questions in the comments. Bye, everybody.